What's up? Japan Market Samurai. You're not seriously thinking, Nikkei just hit 50,000. Maybe I should go all in now, right? Or worse, it's just going to keep going up forever. Listen, while you're waiting, others are already cashing in on the setup. You don't want to be the one left holding the bag after the music stops? This isn't about instincts or having some Wall Street IQ. Timing markets, planning exits, managing risk, all of it is teachable. It's not luck, it's process. And today, you'll learn how to approach this 50,000 level like a pro. No hype, no guesswork.
Imagine this. You're watching the chaos from the sidelines, cool-headed, already in profit. You know the key zones, you see the fake-outs, you nail the entries and exits. While everyone else is panicking at the top, you're executing your plan. Calm, collected, profitable.
I get it, the market looks unstoppable right now. The headlines say, historic highs, your feed screams, bubble. You're stuck between FOMO and fear. But let me ask you, do you really believe just holding on is a strategy? Or buying because it's going up is a plan? If that was enough, everyone would already be rich. Let's snap out of it. This market rewards precision, not emotions. But it's too complicated? But I'm not a trader. But what if I get it wrong? No, enough. You don't need to predict. You just need a plan. This is your moment to stop reacting and start positioning. No more excuses, no more chaos. I was right where you are, watching, hesitating, second-guessing every move. But once I stopped following noise and started using probability-based setups, everything changed. From confused to confident. You're just one strategy away from flipping the game. What I'm about to share isn't in your average newsfeed. This is a limited window opportunity. 50,000 is not just a number, it's a battleground. And if you want to survive this bubble's final chapter, you better know the rules. Let's get into the strategy. Step 1. Strategy over sentiment. Conclusion. You must trade the plan, not your emotions. Chasing price because it feels strong is not a strategy. At 50,000, the Nikkei has entered a psychological zone where emotions run hot. But the ones who win here are not the ones who believe the hype. They're the ones who stick to their rules. Without a defined plan, you're just gambling, and the house always wins. Reason markets punish emotion. Reward structure. Markets are built to exploit emotional decisions. FOMO, fear, hope. These aren't tools. They're traps. At major milestones like 50,000, media noise and social sentiment spike. That's when the average investor gets shaken out. Or worse, buys the top. On the flip side, structured traders already know their entries, exits, and position sizes. They don't need to guess. They already plan this. Example, a tactical approach to the 5-day down breakout. Let's say your plan defines 50,000 as a short-term support level. You wait for confirmation, not just the number, but a reaction. You don't jump in at 50,500 just because it looks bullish. Instead, you scale in on pullbacks, keep tight stops, and plan partial exits at 50,550 and 51,000. You manage your risk before entering, not after. That's the difference between a trader and a gambler. Somunori build a system before you place the trade. If you don't have a map, you can't complain when you get lost. Every trader hits emotional turbulence. The pros expect it and plan around it. When you replace reaction with preparation, you regain control. And in a market this fast, control is everything. In this game, strategy isn't optional. It's survival. Step 2. Think in probabilities, not predictions. Conclusion. Trade the odds, not your opinions. No one can predict the future. Not me. Not analysts. Not algorithms. But what professionals can do is assign probabilities. That's how you shift from gambling to trading. You stop asking what will happen and start asking what will happen and start asking what's most likely and how do I prepare. Probability thinking gives you flexibility. Prediction locks you in a fantasy. Reason probability protects you from emotional bias. When you bet on one outcome, your ego gets attached to being right. You start defending your position instead of managing it. That's how traders blow up accounts. But when you think in probabilities, 40% bullish, 45% neutral, 15% bearish, you're ready for every path the market takes. You're not stubborn, you're adaptive. And adaptation is the core of long-term survival. Example, the Nikkei's winner scenario roadmap. Right now, the setup is clear. If USD JPY stays between 151 and 154 and fiscal stimulus continues, we could test 51,000 or higher. That's the bullish case. Maybe 4. If the market drifts sideways before the BOJ meeting, we're probably in the 49,500, 51,000 range. That's your neutral 45%. But if the BOJ turns hawkish or the yen spikes, expect a dip toward 48,000, a 15% bear case. Each scenario has its plan, not its prediction. Samurui. Certainty is a myth. Preparation is power. Traders lose money chasing certainty, but the ones who build probability trees sleep better because they're never surprised. The goal isn't to be right, it's to be ready. You win not by predicting, but by preparing for all outcomes. That's how you stay calm in chaos and confident in volatility. Step 3. Watch the leaders, not the noise. Conclusion. Follow the movers, not the media. Most people get distracted by headlines. They react to macro buzzwords, political speculation, or whatever's trending on social. But the market doesn't move because of noise. It moves because of money. And money flows into leadership stocks first. If you want to understand where the index is headed, track what's driving it. Reason indexes are weighted, not equal. The Nikkei isn't moved equally by all its components. Just a few names like Vantage, SoftBank Group, and Uniqlo have outsized influence. When those stocks surge, the index jumps. When they stall, the whole market feels it. That's why blindly trading the index without tracking the top contributors is like flying blind. You're missing the signals that actually matter. Example, the Octo 27 breakout and top drivers. On October 27, the Nikkei closed above 50,000 for the first time ever. Sounds huge, right? But the real story was this. Just 3 stocks accounted for nearly 743 points of that move. That's not a market rally, that's a targeted push. If you are watching those leaders, you saw the breakout coming. If not, you probably got caught chasing late or hesitating on the sidelines. Summary, track capital rotation, not crowd emotion. Want a real edge? Start monitoring how capital flows between sectors. Defense, autos, semiconductors, and how leadership stocks behave around key levels. That's how institutional traders stay ahead. They don't guess the trend, they follow the money. When you shift from reacting to headlines to tracking leaders, you stop being part of the crowd and start trading like a pro. Step 4. Prepare for risk while the market looks strong. Conclusion. Strength often hides risk. Markets look strongest right before they reverse. That's why you should never confuse bullish momentum with safety. Right now, everything looks green. Record highs, strong breadth, massive volume, but the faster the climb, the thinner the air. If you're not planning for risk while the market looks great, you're already behind.
Reason parabolic moves attract policy and volatility. The BOJ meeting is just days away. And let's be clear, when the Nikkei hits 50,000 and the yen sits at 1530, policymakers pay attention. Intervention headlines can drop at any time. Plus, Japan's own heat maps are flashing red for overbought conditions. Markets don't crash because of obvious reasons. They crash because people ignore the quiet ones.
Example. What could derail this rally? Imagine this. The BOJ surprises markets with a hawkish tone. Or the yen suddenly strengthens, wiping out the export rally. Or US yields spike again, pulling risk off the table globally. All of these are low probability, but high impact events. And if you're fully exposed when they hit, your portfolio gets smoked. That's why risk management isn't optional. It's your safety net. Samuri, respect the move, but protect yourself. Yes, this market is strong. Yes, the upside case is still alive. But strength without structure is dangerous. Define your stops. Scale out as price extends. Have cash ready if volatility spikes. Professional traders don't just prepare for success, they prepare to survive the storm. Do the same. Ending message, from chaos to clarity. If you've made it this far, you're not just casually watching the market. You're here to master it. You're tired of chasing hype. You want to trade with clarity, confidence, and control. And now you have the tools. Strategy over emotion, probability over prediction, leaders over noise, and risk control even in strength. You're not reacting anymore. You're moving with purpose. Call to action, subscribe, and level up. This channel brings you premium grade insights based on primary data, not recycled opinions. So don't just watch once and walk away. Rewatch, take notes, sharpen your edge. Most people won't do that, but you're not most people. If this video gave you value, smash the like button, it really helps the channel. And hit subscribe so you never miss a tactical breakdown like this one. Got a question? Drop a comment, I read them all. If you've got a topic you want deep dived, tell me, I might turn it into the next episode. Review quick recap of what you've learned. Extended version. Let's take a moment to recap the key takeaways from today's session. Not just to remember them, but to internalize them. First, don't let the number 50,000 fool you. It's just a price level, not a guarantee of more upside, and not a signal to panic. Trading based on how big a number feels is emotional, and emotional trading is expensive. You don't trade milestones, you trade plans. So always, plan your trade, don't trade your feelings. Second, shift from prediction to probability. Trying to guess exactly what the market will do is a trap. Instead, prepare for a range of likely outcomes and assign weight to each. This helps you respond with precision, not panic, no matter which scenario plays out. Trade the odds, not your opinion. Third, pay attention to what's actually moving the index. Ignore the noise, the headlines, the hype. Focus on capital rotation, sector momentum, and the few heavyweight stocks driving the market forward. If you know who's leading the charge, you'll never be caught off guard. Follow the movers, not the media. Fourth, respect risk, especially when things feel safe. Markets look strongest before they reverse. A strong chart isn't a free pass. It's a signal to get even more discipline. Set your stops, manage exposure, and never assume the trend will save you. The best traders plan for downside, while others celebrate the upside. And finally, now that you have the roadmap, there's only one thing left: execution. You don't need more information, you need action. So step into the market with a clear head, a defined strategy, and the mindset of a samurai. Final rewards. Thank you and see you next time. Extended version. Thanks for watching all the way through. In a world flooded with noise, taking the time to think deeply about markets already puts you ahead of 90% of traders out there. If today's content gave you even one new insight, one mental shift, or one clear action step, then this wasn't just another video. It was a turning point. Remember, markets reward those who prepare, not those who react. They favor those who stay patient, keep learning, and refuse to follow the crowd. So if you're still here, it means you're part of that rare group, the ones who want to trade with clarity, not chaos. Stay sharp, stay focused, don't let hype shake you, and don't let fear freeze you. This game is about discipline, not drama. You're not chasing trades, you're mastering them. And above all, trade like a samurai. Calm, calculated, relentless. I'll catch you in the next one. Until then, stay ready, stay dangerous, take care,